Hello everyone, welcome to CFA Guru, and this is the part 2 of the reading 7. The part 1 is linked below and other parts also linked below if you want to watch it. Now in this part, we will see what is internal rate of return. In NPV, we used to bring the cash flows at present value using the discount rate known as opportunity cost of capital, which showed us whether the project was profitable or not. But in IRR, we have to find the discount rate, which brings us to a no profit or no loss situation. That means that the discount rate which turns NPV to 0. Now this discount rate is basically the internal rate of return, which brings the NPV to 0 at a no profit, no loss. Now, why is it called internal rate of return? It's internal because we don't need any opportunity cost from outside to value our projects. It uses the internal cash flows of projects to get a discount. So the formula for IRR is this, which is basically the sum of all the present value of cash flows, which gives you NPV 0, where NPV is 0 and CF cash flows, negative or positive, and R is not the discount rate, it is internal rate of return. Now expanding the formula, we get this formula, which is basically telling you that CF0 is the initial investment, that is expense. So it doesn't need to be converted into present value as it is happening today only. And all the other subsequent cash flows are of future value, and thus we have to bring it to the present value and add all of them. So CF0 is initial investment, that is, it is an expense, thus it's a negative cash flow. So we can write this as negative investment plus all the subsequent present value of cash flows will be equal to 0. Now applying simple mathematics here, we get that present value of all the subsequent cash flows will be equal to investment. So here you get your other formula. We can calculate the amount of investment if we have IRR and subsequent cash. Okay. Now these lengthy calculations of NPV and IRR are not done like this. When there are huge amounts, we usually use financial calculator or spreadsheets to calculate. The use of financial calculator to calculate NPV and IRR are shown in other video, which is linked below. So go ahead and watch it if you want, or watch later while doing sums. Next comes the IRR and NPV rule, which tells us when to accept or reject a project. First, let's understand what are independent and mutually exclusive projects. If a company has, for example, 4 projects and it has the money to invest in all of them, so it can reject or accept the project, that is, the decision of the selection of one project does not depend on the selection of other. That is, the company has ample amount of money to accept all the projects or to reject any of them without depending on another project. So company can select any project without to give up the project, and thus we can say these projects are independent of each other. But in the same example, if the money available with company is less, for example $600, then we get a situation where the projects are dependent on each other. Company cannot select all the projects, thus to select any project, it has to give up another. Thus we can say that these projects are mutually exclusive as they are dependent on each other. Moving on, for independent projects, if NPV is positive, then accept the project or else reject the project. And while for independent projects, IRR states to accept projects or investments for which IRR is greater than opportunity cost of capital. Basically, opportunity cost of capital works as a hurdle rate that projects IRR must exceed for it to be accepted. Thus, if IRR is greater than cost of capital, then accept the project, or else if IRR is less, then reject the project. Now, IRR and NPV give same results, same accept or reject decision when projects are independent. But for mutually exclusive projects, on the other hand, the IRR and NPV may not give the same rankings. This difference in ranking is caused by 2 factors. First, when size or scale of project differs, and second, when timing or interval of the project's cash flows differs. Although during such a conflict, we should prefer NPV for rankings, as NPV of an investment represents the expected addition to shareholders' wealth, and we take the maximization of shareholders' wealth to be basic financial objective of a company.